What do you get when you've got too many ETFs to analyze and not enough time? Well, you get a double header of ETF Battles. Hi there, everybody. I'm Ron DeLegge. Welcome to ETF Guide TV. You heard right. This episode is a double header, so grab your popcorn because it's about to get bonkers. In our first battle of today's double header, you've got two choices: to invest in the S&P 500 or invest in the S&P 500. The question is, which ETF vehicle shall I choose? Well, that's our first matchup. It's between SPY and SPLG, which both track the same S&P 500 index from the same ETF provider, State Street Global Advisors. I get the feeling that we're going to have an oversupply of redundancy in this particular battle, but you asked for it because this was a viewer-requested battle matchup. Yes, hashtag ETF Battles. Send us your matchups. The second battle for today's doubleheader is between SPY and URTH. The latter is an iShares all-world equity ETF. And again, like the first matchup, it was viewer requested. We're going to get this battle started. The first one, and here to help us judge that, is the illustrious Mike Akins at ETF Action. And we've also got with us the equally illustrious David Kreinces with ETF Portfolio Management. Judges, welcome to the program. It's great to have you back.
Thanks, Ron.
Thanks.
So for the first matchup, we're going to go through just three battle categories, one at a time. Each of you are going to pick SPY or SPLG as the winner in each battle category. You got 30 seconds to do that. So let's begin with the first battle category, cost. Mike, you've got 30 seconds. Go.
I'm going to give it a coin flip. For the trader, it's cheaper to go with SPY, but you got to pay a few extra basis points. For the non-trader, it's better to go with SPLG if you're going to hold it for a long, long time, because over time, the fact that it's an open-end fund, meaning that it can do sec lending, and the fact that it's 6 basis points cheaper will very, very slowly pay dividends.
Excellent. And so that's a split decision?
Split decision.
Okay, let's move on. Dave, what's your take on this battle category, cost?
Ron, I agree with Mike, but let's just remember here that State Street, which launched the first ETF in this SPY ETF, really ignited the ETF boom. And the greatest innovation in the S&P 500 ETF landscape today is the 3 times S&P 500 ETFs. So the expense ratio of both of these ETFs at 3 to 10 basis points is an improvement for State Street to lower the expense ratio on SPY. But the real innovation in the S&P 500 is in the levered ETFs.
So who wins this battle between SPY and SPLG?
Well, we'll give the lower cost to SPLG.
Okay, excellent. So let's move on to the next battle category, which is tracking error. Dave, you've got the microphone.
On tracking error, I'm just going to defer to Mike because he'll give you a much better answer, and we're really going to focus on performance, but I'll leave tracking error to Mike.
Mike, tracking error.
Yeah, I blew up my chart as big as I could, and I couldn't find any. So tracking error is pretty much non-existent. Depends on year. But again, it's going to come down to how often you trade it. If you trade it often, you're going to want to stick with SPY. You trade it rarely, SPLG can earn you a few extra bits.
Let's move to the final battle category, which is performance. Mike?
Performance is going to be identical. So it really, what are you trying to achieve? There is going to be no material differentiate. They hold the exact same 505 securities right now, exact same weights. It's just different structure, different liquidity, and I just can't pick a winner or loser.
Dave, performance, who wins the battle?
So I agree with Mike. Performance is pretty identical here. So it's great that these two S&P 500 ETFs were neck and neck and gave you 5 to 10% annualized the past decade. But the 31% delivered by the 3 times S&P 500 is really the impressive innovation in the S&P ETFs.
So this is a split decision based on my battle scorecard, as you can see there. And what I'm hearing based on what the judges have determined, SPY for traders and investors that have a shorter term time horizon. Also, I don't think we mentioned it, but it's worth noting a deeper and more active options market, which again defers to the trader aspects of SPY. And SPLG, if you're a longer term investor with the lower expense ratio over time, that's going to compound in your favor. So this is a split decision. It really boils down to how you use the ETF. Our next battle matchup for today's doubleheader is SPY versus URTH. And we've got 4 battle categories: cost, diversification, risk, and performance. Each of our judges, like the first battle, has 30 seconds to judge each battle category between SPY and URTH. They can pick one winner or do a split decision. So let's begin with the first category, cost. Who wins the battle? Mike?
SPY wins hands down. There's no reason Earth should be that expensive from an iShares product, given they're both trading mega cap or large cap developed market securities. So SPY on absolute cost.
Good analysis. Dave, what's your take?
Agreed. SPY is the cheaper ETF at 10 bips versus 24 bips for Earth, so 2.5 times the cost. But when you're picking between these ETFs, it's really not about the cost. It's an insignificant difference. The question is, do you want the broader diversification, and is the performance worth it? So the cost difference is negligible, but we'll call it SPY for being cheaper.
Let's move to the next battle category, risk. Dave, you've got the mic. Who wins this battle in risk?
So both of these equity asset classes are extremely risky. They can both give you a 20 to 30% decline quickly in a bear market or a crash, if not worse. Overall, the SPY in the US has held up much better during extreme periods of stress over the past decade. So we'll give the lower risk win to SPY.
Mike, what's your take on risk?
Yeah, I think the United States of America is the safest equity markets in the world. From that perspective alone, if you're looking at risk, you gotta give the nod to SPY.
How about diversification? That's our next battle category. What's your take on this? The winner between these two ETFs in this category, Mike?
So they're both very well diversified. Earth, because it tracks a larger market, has more securities, 1,200 securities to SPY's 500. However, if you look at diversification from a sector, country, that's where you start talking about where you're going to get your differential in return. There's about a 65% overlap between Earth and SPY because the U.S. market, from a developed perspective, has about 65%. But what I like to think of is more old world, new world. If you look at the sector diversifications from the U.S., it's going to be heavily tilted towards technology, healthcare, innovative consumer discretionary like Amazon. If you look at the developed markets, and that's what Earth is, it's a developed markets, all world ETF, you're going to get a lot more old school financials, old school consumer discretionary, consumer staples, and that diversification is what's going to drive the difference in returns. So Earth's a better value play, but from a growth perspective, SPY all the way.
Okay, so diversification, who wins the battle?
SPY.
SPY for diversification?
Yep.
Excellent. Okay, let's move on. Dave, what's your take on diversification? Who wins the battle between SPY and URTH?
You know, Ron, I always love Mike's analysis, but I'm going to disagree and prefer Earth on diversification just because...
I hate his analysis.
Just because the U.S. is 66% of Earth, so it's more diversified in that regard. But I think in general, diversification isn't really the main reason to pick one of these ETFs. They're both broadly diversified. Yeah. It really comes down to performance. So, just like some other ETFs we've battled, cost and diversification are far less of an issue as performance.
So take it from there. That's the last battle category, performance. Since you got started, who wins the battle between SPY and URTH when it comes to performance?
Over the past 5 years, SPY has delivered about double the performance of Earth, 8% annualized versus 4%. And SPY is down a little bit less than Earth year to date. So overall, SPY easily wins, but investors have to keep a close eye on their risk and diversification because trends can change very quickly. But for now, overweight in the U.S. continues to work very well for investors.
We're going to defer now to Mike for this last battle category. Who wins the battle?
I'm giving it to SPY, both for the country exposure being the US versus more broad sector exposure. And the final thought on this is, I don't know why you would buy a developed market ETF that excludes more of your growth opportunities in emerging markets for 66% that's already 66% S&P 500. It's a much better way to diversify overseas than doing it with URTH. So SPY for performance, and for look forward, it's better inside the portfolio.
Well, thank you, judges, for weighing in according to my scorecard for this hard-fought battle between SPY and URTH. The battle winner is SPY, that's the Spider S&P 500. The fund beat URTH in key categories like cost, risk. Diversification was a split decision, and it won, though, handedly in terms of performance. And so SPY, I mean, it's only the most heavily traded security in the world. It's sort of hard to miss, but you don't really need to put it on your watch list, because whether you like it or not, it's already on your watch list. So that does it for this round of ETF battles. Thank you again to Dave and Mike for doing an excellent job judging these matchups. We did a double header on today's ETF battles, and that you guys did a great job. So the question that I've got before we sign off is, which ETF battles would you like to see in our next episode? Well, post your thoughts in our YouTube comment section, or hit us up on Twitter at ETF Guide. Be sure to hashtag ETF Battles. Thanks again for watching. I'm Ron DeLegge, and until next time, watch the battle before you invest, right here on ETF Guide TV.